Hello and welcome, my dear investors. Let's talk about Netflix. Yesterday, the stock took a hit, 7.5% lost because of this report, which was released. It's a quarterly report for the first quarter in this business year on 2021. And Mr. Market was a little bit disappointed, sent the stock down about 7.4%. And you see that the dip is not that deep, but it's a dip anyway. I will tell you what happened and if it's a nice occasion now to buy the stock. And this question is related to what yield, what capital gains to expect in the near to medium future. And of course, in the long future if you're a serious investor. My name is Thorsten Tiet and I am the founder of Dividend Stocks Cash. You will see this screener in action very soon. But first, what happened to Netflix in the last quarter, or what was that disappointing? It was the number of subscribers, which was about 4 million, and 4 million was less than 6 million, which was the expectation from the management, or the estimate from the estimate from the management. And the reasons are not that surprising. It's always Corona. Due to Corona, a lot of subscribers subscribed earlier because of the lockdown. And now the number of subscribers is a little bit lower because these people already subscribed. That's not so a big tragedy in my point of view. What Mr. Market did not like is the outlook for the current quarter. Management says number of subscribers will go down even further to about 1 million, which is lower once again than 4 million, which is even worse. And I think this was the main reason why yesterday the stock price dropped about 7.4%. On the other way, we have the opposite side of the medal. We have another reason why management thinks that the number of subscribers went down, and this is there's a problem in the pipeline of content for Netflix, and this is also due to Corona. So productions were delayed. Basically, this means that the offer is not that attractive as it could have been if Corona did not happen. Okay, but this is also something temporary, and in the second half of this year, management thinks, is optimistic, the pipeline will be fueled once again with many, many highlights to see. Okay, what else do we have? We have some positives, and this is the flip side of the coin. And this is because the pipeline is more or less empty, which means that the production costs of new content went down, which means that the cash flow expenses went down as well, and the earnings went up. But this is a metric Mr. Market did not pay attention to, and I think I can understand why. So the earnings per share beat is just a beat because of, I would say, technical Corona issues, which led to less subscribers. So it's not something to be that happy about. Let's have a look at the stock, or let's have a look at an Excel sheet I did for you, of course. And what this shows is the number of subscribers quarter by quarter, and even compared for the last quarters to Disney. Because management said that the competition is no reason for the subscribers, for the new subscribers going down. And I am inclined to believe, because for Disney we see the same trends as for Netflix. Disney in green and Netflix in Netflix red, and you see that the lines here, they correspond to each other. And Disney also lost subscribers. They did not lose subscribers, but the number of new subscribers decelerated. You see here in million on this axis the number of new subscribers. So for example, during Corona it was more than 50 million in the quarter the year before, and now we have this one about 4 million. Of course, the number of new subscribers for Disney is much higher because their product or their streaming service is much newer. Not so many people subscribe there yet. More to gain. So these are just something I wanted to show you. And now let's go on. And here we are on dividend stocks cash. Just within 3, 4, 5 minutes maximum some fundamentals about this company. So you see a nice earnings growth, very nice earnings growth. We already have the new numbers here. They are still preliminary, but they are already the numbers which will be final. And you see earnings per share, great. You see the operating cash flow and free cash flow, both here, operating and free cash flow. They are going down. They went down for a long time, but now we are cash flow positive for a first time within the last, for a very long time. And this indeed is a nice change because investors were worried that we have a cash burning company here. In fact, Netflix did burn cash for a long time and they still posted profits because they depreciated the production costs, the costs for series, for a film, for some years to come. This means that the earnings didn't run negative, but they posted positive earnings. Okay, and here you see the debt situation. It became worse from year to year. The debt became heavier and heavier. You see it here. I just show you. Here you have the interest-bearing debt, which went up. This is the debt ratio, which went up from less than 10% in 2013 up to about 50%. And now there's a turnaround, and thanks to positive amortization power, which means positive free cash flow, it's the same for Netflix because they don't pay dividends. Here you see that the debt got reduced. This thanks to this positive amortization power. So this is very good, and the management is optimistic that this will continue. This positive cash flow trend will continue. That much to the fundamentals about Netflix. Now it becomes very interesting going to the valuation of this company. By the way, here we have the segments, which might also be interesting for you. They report streaming as one segment, and the other segment is DVD. You can see it here. DVD isn't important anymore. Who reads, who watches DVD? 99% by streaming. International streaming, domestic streaming. Domestic, it's the United States. That's where they started streaming back in, I don't know when, but the first time they reported it was 2012. And abroad was just 8%. Now abroad, outside the US, is more than 50%. It was already in 2019, and now it will be even more, most probably, but they don't disclose it. Anyway, that's the valuation. Let's go there. And if you want to evaluate this stock or know if it's a good buy opportunity or not, and what kind of yield to expect from the stock, then let's look at the adjusted earnings per share. You see once again that we have a nice upward trend. Based on the last 10 years, we have a price earnings average based on adjusted earnings of nearly 77, which is very high. But I think we should go down, and we should just take a very short term to calculate the average and not this long term, because here we have price earnings of more than 100 because the earnings were very low back then. Now they are much higher. Now they are probably more representative, although it's a very short historic period. So now we have 60. Let's zoom in a little bit. What's also interesting is, let's check this out. What yield did you do if you bought the stock back in 2002, then your average annual yield based on 100% by capital gains was 43% each year, 43%. That's very nice. And here you see it always went up. You even can't notice the dip in this perspective. So, but we also see that within the last months, we have a very volatile sidewards trend. Now let's zoom in and we'll look at the valuation right now. Here we are. We just took a very short period for the evaluation of the company, and let's get rid of this one. So now this 60, you must live with that. You must see, okay, the 60 price earnings of 60, I think this is fair for the valuation of this stock. We have here growth rates, adjusted earnings of about 50, 25, 34, 25%. So about 30% on average, I would say, for the next 3.5 business years. You could say, okay, that's fair because we already have a proven business model, and we still have a lot of space to grow this company. If you say, Anna, 50 is a little bit too high for me, then let's go with 50, for example, and then the stock looks a little bit overvalued right now with about $509 compared to fair value of $460 based on the last 4 quarters. But what to expect? You might expect for the current business year even slight capital gains, because the fair value based on the end of the current business year is $531, and because the earnings go down, the fair value goes down as well, and then you can see it here once more. And this is really really fascinating if you look how the fair value is climbing up. So here we have the fair value of $530, $670, 900, $1,133. So if you believe in the story, and if you believe in the growth rates, and if you believe that the market is willing to price the stock with a price earnings of 50, then you might expect an annual yield of 24% for the next, or within the next 3.5 years. So I think it's a nice investment. It's a nice investment opportunity. It's not a bargain yet. Netflix is not a bargain yet, and the stock is currently here in a sidewards trend. So Mr. Market, I think, is going to price the stock a little bit cheaper by buying time. So the stock is not really going down. I think it's too attractive, really, to lose, to have a lot of capital losses. But just by going sidewards, if the fair value goes up, then the stock becomes more and more attractive. And I think it's just a question of time until we see new capital gains and new high prices on the stock we've never seen before. So, okay, that was my message, my little analysis about Netflix. If you like, drop me a comment, say what you think about this stock. Thanks for watching. See you next time. Bye bye.